Let's talk about mortgage refinancing and what to expect when you refinance your mortgage and the truth about the no cost loans that people are advertising. Thing about refinancing your mortgage is that you are going to have some costs. You're replacing the current mortgage with a new mortgage. So whether you're trying to get a lower rate, trying to get cash out of your home, or even doing a second lien, leaving your first alone, there are going to be some costs, and there's going to be pretty much the same process. So the first thing we want to talk about is just a straight up refinance. Refinancing means that you're replacing your current mortgage with a new one, usually to lower your interest rate, reduce your monthly payment, or even pull out cash and use some of your equity, or change your loan terms. You may want to go from a 30-year to a 20-year, or you may want to go from a ARM to a fixed rate mortgage, or stretch it out. So we still have to make sure there's benefits for you to do it. And that still has to go through underwriting to make sure it's not doing something that's called loan churning, where banks just refinance people for the heck of refinancing them. So what to expect in the process, you're still going to do an application, and with your application, we're going to do a consultations. We're going to say, what are your goals? What are you looking for? What are you looking to accomplish by doing this refinance? Are you looking to get cash out? Are you looking to lower your payment? And then how much are you looking to lower your payment? And then if it's a good loan consultant like myself, I want to say that's not realistic, or this is what's more realistic. You have to decide if it's worth it for you. We're still going to review your credit, your income, and your equity in your home. So that means you're still going to have decent credit. You're still going to have income, if not more income than when you closed before, and then your equity in the property. So depending on your equity in the property, gives you different options for the refinance and if you can get cash out and everything. Once we do that, we're going to consider your loan options and the best strategy for you to accomplish what you need. So we'll structure the best loan for your situation. So if you may want to do a streamline instead of a full rate and term refinance where you need an appraisal, or you may not want to mess with your first lien. You have enough equity in your home, but you need some cash out for renovations or repairs, or to go on vacation or pay off some other bills. You may want to do a HE loan or a HELOC. Those are the things that we'll look at and let you know that's available. Income and assets. You still need income and assets, even though you are getting a refinance. Your assets, a lot of times, if you're getting cash out of your home, you're taking equity out of your home. The banks want to see that you still have reserves for 3 to 6 months, depending on your credit and the type of loan that you have. If you have multiple homes, the bank may want to see that you have enough, at least 2 to 3 months reserves for all those homes. If you're taking cash out or refinancing your home, so you still have to get automated approval, whether it's Fannie Mae or Freddie Mac on some of these. If it's a non-QM loan, it's more of a manually underwritten loan, and they have their own guidelines. So you still have to provide your income and assets. Next thing, an appraisal. Some loans, if you go through the system and you have enough equity and there's a lot of AVMs, automated value assessments out there, then you may not even need an appraisal, depending on if you're doing a full doc loan. But most of the time, you will need an appraisal. Even if it's a second lien, they may do just like a drive-by appraisal, but you will need some type of appraisal or value management, assessment on your home. Once that's done, you're going to also need title. You'll have an owner's title policy. So that's something usually that people don't have to pay for, but you still need to get title pulled on your home to make sure there's no outstanding liens or judgments against your property. And if you do have judgments, even if they're not against your property, the bank will most likely make you pay those, because we don't want those judgments to be attached to the home. Once we get that information, the appraisal, all your income and asset documentation, everything, it goes back to underwriting. The underwriter will review it, give you an approval, or condition you for some other items, and then you'll get a clear to close, or like I said, you'll get a clear to close. Usually, if it's your primary residence, you have what's called a rescission period, a 3-day rescission period. That means, like, just because you close on Tuesday, you won't get your money on Tuesday if you're getting out, or even if you're not getting cash out, you have a 3-day rescission period to say, you know what, I don't know if I want to do this, and I can actually back out of it within 3 business days of the actual closing. So that's something that's always there to protect people in case they were kind of feel like they're getting railroaded or forced into something. There's those protections on it. If you're getting cash out, that 3-day right of rescission means that you won't get the cash out of your home that you requested until 3 business days, and then make sure you don't sign the right of rescission paperwork. So as far as it comes to the no cost refinances, you still have cost. We just mentioned you have an appraisal, you have title fees, you may have judgments or something that you have to pay off. You have subordination of liens. If you took out some money, if you did a loan with someone to renovate your home and you got new windows and doors and all that stuff, that loan may have to be paid off, or we'd have to get permission for that company not to pay off that loan, like if it's just a rate and term refinance. So those are things that could come up with it. So usually what they mean by no cost is if you have enough equity in your home, even though you're lowering your interest rates, you can increase your loan amount to cover those costs. Or some people like to pay the cost out of pocket. They're like, hey, I just want to pay all my closing costs out of pocket. That's up to you. Most people don't opt for that. And then a lot of times it's built into the rate to where maybe you had a lower rate, but you want to build all the cost into the rate. Then those are things that are done. So it's done with premium pricing. So just want to be honest with people up front. There's no such thing as a no cost refinance. You have lender fees, title and attorney fees, appraisal, escrow, and prepaid costs. So you still have those same escrow and prepaid. So when you go into the new loan, you'll get some type of adjustment, an aggregate adjustment from your previous lender as far as the prepaids and everything, but you do have to update your insurance policy. Depends on if you were escrowed or not. So people who weren't escrowed have to pay for another whole year up front. And then you have to just make sure you have enough escrows in the account to start the new loan. So the difference is just how you pay them when they talk about no cost. How it really works is, like I said, you're either going to have it built into your rate, or the lender's going to premium price you to give your credit, and that credit covers your closing costs. So the smart strategy is not the same for everyone. It depends on what you're trying to achieve. If I need money out right now and I'm not going to be in this house this long, you may want to pre-price it. You may want to build those costs into your loan. If you're like, I'm going to be in here forever, I got the cash, I just want the lowest rate possible because I never want to refinance again, then you may want to pay those costs up front. So this just depends on what your plan is, and you should get options and let us show you all the options. And then there's other things that you want to look at. If you may want to refinance into a fixed rate into an ARM, because you're like, I know I'm not going to be here more than another 7 years, 5 or 7 years. So you may want to do a 5/1 ARM or buy downs and things like that. So again, the strategy is what you get approved for, and also what's going to help you at the time. So it's always a different plan to get into your home than to keep your home and to make your home useful. Sometimes the mortgage that you got into the home is not useful to you anymore, other than having a place to live, and you have enough equity where you can use it. But if you want your own strategy, you want to get pre-approved for your refinance, give me a call, 404-461-3172 or reggieloans.com. Talk to you soon.